Mortgage rates are getting out of control. Let's talk about it. What's up, everybody? Reno Reed here of the Reed team with Troutwell Realty in beautiful Kansas City. And like I said, mortgage rates are getting a little ridiculous, going from record lows to closing in on 5%. So let's talk a little bit why that is. And the big reason is the Federal Reserve. So for those of you who aren't familiar, the Federal Reserve is an entity which goes ahead and it buys and sells a lot of different bonds and things of that nature. It's independent from the government, but they lend out a ton of money, so their rates are very important. So they also buy what are called mortgage-backed sureties, and that's what we're going to be focusing on today, because that's what really impacts the lending, the mortgage rates, more than anything. So now that we understand that, why are we seeing some of these changes? Well, in November, the Federal Reserve talked about how they were going to scale back the purchase of some of these bonds. Now, it's kind of normal. They were at record rates during the pandemic. It had to end at some point, but November was a little bit sooner than a lot of people thought it would be. So, not anything too alarming yet. December of 21, they announced that they were going to scale back, but at an even faster rate. Now again, this wasn't a huge deal yet because they were still reinvesting that money. So just like your lender, when you pay off your mortgage, they're going to lend that money somewhere else. It's essentially the same thing that the Fed was doing, except at a much, much, much greater scale. So again, nothing too out of the ordinary. January 5th, 2022, the meeting minutes for that December meeting came out. Now, it's not that the time frame was weird. There's usually typically a 3-week lead time for them. But the minutes did discuss things that were discussed at the meeting that didn't make the official policy announcements. They talked about getting back to standard normalization at a little bit faster rate and raising rates at a much faster rate as well. Now, it's important for me to note, the Federal Reserve doesn't directly set the mortgage rates. In fact, the lenders typically do, but they do it based on what they expect the Federal Reserve to do. So when the Fed starts doing things that are kind of erratic or quick, abrupt, spontaneous, you're going to see a jump and you're going to see a correction, for lack of a better term, in a much faster way. The bigger the surprise, the bigger the jump, the bigger the shock. So why does the Federal Reserve make these shifts in the first place? Well, they have two primary tasks that they're thinking of. One, they want everybody to be employed, full employment, and two, they want to kind of curb inflation. Now, us who've been living under a rock, I think we all understand that inflation is kind of the big key here. Whenever something happens that increases inflation or has the threat to increase inflation, the Federal Reserve can hike their rates. The speakers for the Reserve can also add some panic by, validating the fears within the market that people have to be afraid or worried about these rate hikes. It's just like dumping gasoline on fire. But we're experiencing individual events such as, economic policies, global health pandemics, geopolitical conflicts in areas of the world like Ukraine that directly impact commodities like gas and oil. Each one of these events could very realistically itself lead to inflation. We're unfortunately dealing with multiple of those at the same time. So they, of course, have to start making some corrective measures. Now, could they have done something sooner? Absolutely. In 2021, they were pretty hesitant to make any changes because they didn't really know how any of the COVID variants were going to manifest, what kind of issues were going to come up. But at the same time, they like to try and move more slowly, more predictable, so you don't see these giant spikes in things like we're seeing now in the mortgage industry. When they make these rapid shifts, the market tries to get out in front so that they're not left holding the bag whenever they do raise rates and all of a sudden they're not making money on it. So out of all this, what does that mean for the future? Is there any hope? And the odd answer is yes, there is. Because the reality of the situation is we want the mortgage industry, the lending companies, the banks to expect what the Federal Reserve is going to do flawlessly. That is ideal. That is going to bring it the most stability. So now that we've kind of had a bunch of jumps, and the rates are still raising, don't get me wrong, but as long as we're out in front, as long as we expect what's going to happen, even if the Federal Reserve continues to raise rates, as long as that's what's expected, it's going to stabilize, it's going to normalize much, much faster. It's, again, when they start making these massive changes, these quick shifts, that we start seeing a lot of the big spikes, the big corrections, again, for lack of a better term. As long as it's expected, it can be accounted for. Again, it's not to say the rates aren't going to go up, the rates aren't going to go down. As long as it is kind of planned for, it can be a lot more stable and sustainable long term. So hopefully, all of these big changes, these big spikes are behind us so that we can have those planned for, so that we get back to normal faster than anything. Now, again, like I said, we gotta wait and see how it goes. Our rates are closing in on 5%, which still historically is pretty good. We're kind of in the same ballpark as we were the entire 2010s, which until we had the pandemic and we started seeing record low after record low after record low, that was the lowest that we had in recorded mortgage history since like the 70s. So it's not necessarily all doom and gloom. It does suck going from 2% to 5%, things like that. It's not a fun time, but there is real reason to be optimistic for it. So based on these rates rising, if you're looking to buy a house, get with me. I'd love to help facilitate that, get you in contact with some lenders, get your rates locked so that if they do go up, and that when I say rate lock, that's going to be your rate ceiling for 60, 90 days, whatever the case might be. If it goes below that, you get the better rate. If it keeps going up, you're locked at that ceiling. Now's a good time to start having these conversations. Alternatively, if you're looking to sell your house, I would recommend looking into it sooner than later. When the rates continue to go up, if the rates continue to go up towards 10%, money's going to start becoming expensive, and a lot of people won't be able to afford your houses. These are big, big changes, and there's things for us to keep an eye on, right? I'm not a doom and gloomer by any stretch of the imagination, but now might be the best time in the near future for you to put your house on the market while there's still just an insane amount of demand for your house. While you're here, go ahead and follow me on my socials down below. I'd love to connect with you, and in the weeks and days to come, there's going to be plenty of long content, short content that I hope you find educational and informative. But until then, see you guys next time.